the intention today here is to really kind of answer your specific concerns, okay? Obviously, we're guys that have dedicated our life to credit. We love credit, we use credit, we leverage credit, and everything we do with credit has to do usually with entrepreneurship and real estate. The good thing is we have a nice, intimate, small crowd, so we're able to kind of just talk about your specific needs and wants. And at any point, you guys, if you have any specific questions, if you feel the time is appropriate, you can ask it. If you just want to kind of maybe write it down so we can address it later, you're more than welcome to do that. Okay. Now, I usually kind of hold these presentations myself, but I think there's somebody a little bit better suited than I am to give you information about the credit restoration side of credit, right? Because I'm assuming a lot of you probably have maybe questions about student loans, maybe collections, maybe repos, or whatever it might be. So with that being said, I would like to introduce our company's co-founder and senior attorney, Mr. Shiva Bhaskar. Please take it away.
Thank you, Tony. And thanks to all of you for joining. I know we had folks come in from all over, and it's a busy day, so we appreciate you being here. Let me get this fired up. Okay. So a bit of background about Tony and myself, so you can kind of get an idea of where we're coming from. So I'm a consumer rights attorney. My journey with credit actually began after or around the time I graduated from law school and was unable to pay about $150,000 of student loans. Actually ended up defaulting on them, had a 514 FICO score, and I came out of law school just about 10 years ago. And for those who remember what the economy was like at that time, not very friendly to anyone trying to find a job, especially someone fresh out of school. And eventually things stabilized and found employment and went to a firm and all. But from this experience, I became very passionate about the field of consumer rights, about credit, about debt, and about how we could empower people to take control of these issues and ultimately build themselves a better future and a better life. And a lot of that comes from the reality of coming from an immigrant family where these things are not necessarily taught. Certainly no one in school teaches these things, at least not at my school. And so as a result of that, out of our experiences, that's how it resulted. Tony has a fascinating journey as well. He came to this country as a refugee right before high school. And funny enough, we actually grew up together. We went to school together. He purchased his first investment property 2006, so yeah, about 22 years old, 23 years old, netted quite a handsome profit on that, has been doing it ever since. But for him to get to that point where he could purchase that property, he first had to fix up and then build better credit. And that's how Tony got started on this journey, and we eventually came together to do what we're here, to do what we're here for today. Now, just to cover a little bit about what we'll be focusing on today, the most important thing to really mastering and having a good credit score is to really understand how your credit is decided, what goes into it, what improves your credit, what reduces your credit. Because if we understand those factors, we can really take a step back and say, okay, how can I make sure that that profile, those factors, is as strong as possible for me, right? That's the first step, is to understand how credit works, both credit reports and credit scores. That's what we're going to go into. Now, we all care about credit for some reason. It's not just a 3-digit number that's out there and is kind of interesting for us to know. Credit impacts everything. The most obvious examples are buying a home, buying a vehicle, renting an apartment, but also in many states, things like insurance, qualifying for credit cards, personal loans. If you're looking to start a business, initial business funding typically requires a personal guarantee. So our personal credit is very much a factor for so many aspects of our life. And the statistic that always got me, for those who are familiar with Credit Karma, the website, they actually did a study, okay, where they went into folks' credit reports and credit scores and looked at the financial consequences of challenged credit. And they figured that over a 15 to 20 year time span, a person with poor credit would spend over $100,000 more on mortgages, in auto loans, in credit cards, in payday loans, in all of these predatory products, simply because of that 3-digit number. Now, you really let that sink in. All the things that someone who was facing those challenges could have done with that extra money. And then from that, we can see how important it is to enjoy the best score possible. Now, of course, identity theft, massive issue right now. We know lots of folks are dealing with it. It impacts millions of Americans, not to mention the businesses that also incur losses as a result of identity theft. The best thing that anyone can do when it comes to understanding how to reduce the risk of identity theft is take a few simple steps, which we're going to cover today. Another issue, student loans. It's one of the most common concerns that Tony and I hear about, both from our clients as well as from our referral partners, realtors, mortgage lenders, and other folks. The student loan crisis is at an all-time high in this country, over $1.5 trillion in student loan debt. So we're going to go into a few strategies for folks to protect their credit when they have student loans and also to manage the loans. And then lastly is basic money management, because ultimately credit comes down to smartly managing your money so that you're able to pay your bills, you're able to make proper use of loans, and you're able to ultimately create a stronger financial future. So obviously we have a number of slides up here. I want us to be interactive, okay? So each slide will go over some points, and then I'd like folks to present their questions, ask it to me. We're going to really try to make this a discussion, a dialogue, since we have an intimate group here this evening. And hopefully that way we can cover everyone's questions. And Tony and our team and myself will be here after as well to sit down with each of you individually and answer your questions as well, if you'd like to talk one-on-one instead. Shall we dive in? Everyone ready? Cool. Terrific. So before I give you the answer to this, I want to ask everyone a question. Don't be shy. There's no bad answer here. The question is very simple. What is credit? Anyone want to volunteer an answer? Security. Terrific. Security. Absolutely. Ability to carry debt and pay it back. Absolutely. Absolutely. Yes, it's very much security with credit. You enjoy peace of mind and security. And yes, you've shown the ability to manage your debts. So, simple definition, credit is a very ancient concept. We talk about FICO scores and credit reports and all these very modern concepts. Credit has existed about as long as civilization has existed. You know, if you read about it, back in the days of the Greeks and the Romans, you had merchants, okay, who used to travel massive distances to buy and sell and trade goods. And they weren't necessarily always paid or didn't always accept payment at the time that the goods or services were exchanged. So how did they know that they were going to be paid back? That was off of the basis of trust, or literally, I believe or belief, which is what credo, credit, stands for in Latin. I believe that this person is going to pay me back. And if I don't believe it as much, then maybe I'll give them the money or maybe I'll make the agreement, but I'm going to ask them to provide me with some sort of assurance, whether that's some sort of deposit, whether that's paying me an interest rate, whatever it may be. So credit fundamentally is about trust and about belief, okay? Do I believe that this person is going to meet their obligation? Now, obviously, if everyone knew each other and automatically knew, okay, this person is trustworthy, I can believe what he says, I can believe what she says, then this wouldn't be an issue. But that's not the case. And so since the ancient times, they have been coming up with different mechanisms of understanding credit. And today, that's what leads us to where we are today with credit scores, credit bureaus, and so on. Okay? Do I have any questions on this aspect of it? Okay, terrific. Now, credit score, okay? So we covered what is credit. If credit is about trust and belief, then a credit score is basically a measure of how much you trust or believe that someone's going to meet their obligations. Now, this is kind of a tricky question, but I'll put it out there. Does anyone know what exactly your credit score measures? Any guesses, please?
Creditworthiness.
Yes, that's exactly it. It measures creditworthiness in the sense of, is this person going to meet their obligation? That's exactly it. And more specifically, it actually measures the chances that you won't meet your obligation, okay? And it's a very small difference, it sounds like, but it's actually important. Credit scores, as we understand them and as is shared by FICO and others, it doesn't so much determine whether a lender believes that you will pay them back so much as the risk that you won't, okay? So credit scores are very much, in large part, about avoiding mistakes and avoiding certain behaviors that are going to make the mortgage company, the landlord, the auto lender, the credit card folks, avoiding things that are going to make them think you won't pay them. Because their assumption is that you should pay them, okay? The the default state, the thing they're looking for is, I gave you money, you pay me the money back, right? Now, anything that suggests you won't pay it back is what they're looking for. So credit scores are really a measure of the chances that you won't pay your bills, if anything. Now, more specifically, they predict the chances of you going 90 days or more late within the next 90 days. Now, that's a mouthful, okay? Let me back up. What a credit score tries to predict, FICO score specifically, okay, is if I give this person some money, within the next 90 days after I gave them the money, are they going to fall behind or stop making payments such that they're 90 days or more behind on their minimum payments? Why does the 90 days matter? That's the question we always get. 90 days in the credit scoring world is considered what we call a KD, or key derogatory, okay? What that basically means is that if you're 90 days or more late on an account, the loan company, whether that's your mortgage lender, auto lender, credit card, in their experience, if you're 90 days or more late, there's a serious chance you're not going to make any more payments on the account, and they're going to lose the money. So their concern is always, how do we make sure that we're really carefully looking at this applicant and seeing whether they're going to fall those 90 days behind. That's not to say they don't care if you're 30 or 60 days behind, okay? Of course they do. And we're going to cover that more in the rest of the presentation. But their real concern and what they're measuring with the score is the 90 days, okay? Now, do I have any questions about that aspect of it? Okay, let's carry on. So, credit scores are measured from 300 to 850, okay? So 300 is the lowest, obviously, 850 is the highest. Now, here's one of the most, I think, important points to keep in mind. Does anyone know how many different credit scores are out there? Just rough guess. 10? More? 20? More? Ah, you guys, okay. 25? Okay. Actually, there's actually upwards of about 70 different credit scores out there, okay? There are two broad types of credit scores, okay? FICO and Vantage. FICO stands for the Fair Isaac Corporation. They're a company up north in the San Jose area. They have been predicting credit risk since the 1950s when this was considered a supercomputer, okay? Way back then, ever since then, they've been predicting whether people are going to default on loans, whether they're going to fall behind, okay? FICO is the most widely used credit scoring formula, okay? So if you go to a mortgage lender, auto lender, credit cards, personal loans, around 88 to 90% of them are using FICO, okay? But there is another credit scoring model, and it's what a lot of folks know about or hear about, and that's the Vantage score. And the reason why people know about it is because, show of hands, how many people here have used Credit Karma before? Okay. Credit Karma is a free credit score website. They give you the Vantage score, okay? And they have millions and millions of users, and Credit Sesame and all these banks, Chase Bank gives you free scores, all these folks give you free scores. The thing is, most of them are giving you the Vantage score, which the lenders are not really using, okay? FICO is what lenders use, and there's many different versions of FICOs for auto loans, for mortgages, for credit cards. They're constantly updating and putting out new versions, okay? You get a new one about every 2.5 to 3 years, and then some lenders start using those new versions, others keep the old ones. But the point is, your FICO score is what's really going to matter. And we're going to go over where you get the FICO scores. I just want to kind of underscore this point, because a lot of times you're going to say, oh, you know what, I have a credit score of 620 or 550 or 790, and you're looking at the Vantage score, not FICO. And you need to know that, because when you go for a loan, your FICO score and your Vantage score are typically pretty different. Often your Vantage score is a lot higher than your FICO score. So you don't want to rely on that, right? For the simple reason that you don't want any surprises when you go to the car dealer and then they say, yeah, I know you check Credit Karma, but our score says you actually have a 540 and we want, 22% interest. And for that reason, FICO scores are what we're going to focus on, okay? So Vantage is being used at a very small, test scale. You do have a few apartment landlords who use Vantage. Discover and some others have used it on a trial basis. But for the most part, no one has widely used it. See, the interesting thing with Vantage, the three credit bureaus, Equifax, Experian, TransUnion, they actually created Vantage, right? And they said, we want to make it a competitor to FICO. But they haven't really caught on for major lending decisions. Like Discover uses it for some of their very low-end credit cards in some cases, the secured ones. Sometimes they use the Vantage score. But for everything bigger than maybe a couple $100 or a really small transaction, you're typically going to find FICO. Like if you go to the store, for example, right, like say Best Buy, Walmart, those guys continue to use FICO. And Vantage has been pressing them for years, hey, use our scoring, but they continue to say, no, we're sticking with FICO. So you do encounter places that use it, but it's rare enough that I'm like, you know, if it's 9 to 10, 9 to 1, usually we focus on the 9, right? So yeah, that's what I would say, but thank you, great question. So your credit score can change at any moment, okay? Let's say that you had some late payments and those get removed, score goes up. Let's say that you have some credit cards in good standing, but you run up a lot of debt on them. You do a lot of Christmas shopping, Thanksgiving, holidays, then your score goes down. So your credit score is really a snapshot, okay? It's really at that particular moment, on this day, okay, on March 5th, what is the risk that you're going to go 90 days or more late on an account at that moment? And the good news about that is obviously you can get it up, and obviously if certain mistakes are made, it goes down. But we do have control over it in terms of our behaviors, and when we know what those behaviors are, then we can control it. Now, you're going to see this in a little bit more detail shortly, but basically what you're looking at up here is, depending on where your credit score falls, okay, if you fall in this very low range versus if you go higher, this applies to pretty much every type of credit, okay? For example, mortgage loans, unless you're about in here, you can't even really qualify. But even within that, the higher that it goes, the lower your rate goes. Auto loans, similar thing. Auto loans, you're about here at a minimum, but the rate would probably be more like there, and then it goes down as the score improves. Even for credit cards, and this is not widely known, but for a lot of credit cards, okay, they charge very high interest rates, 21%, 23%, 26%. But when they assess that interest rate, it's not equal for everyone. When they pull your credit, they actually decide what rate they're going to offer you. You can go to Chase, okay? You can go to Chase Bank and sign up for a credit card. And if their minimum score for, let's say, Chase Freedom is around a 650, 660, they'll go and quote the person who has that 650 the 23% interest. While the person who comes in with the 730, let's say, 740, for the exact same card, same limit, same income, they'll go give that person 12 or 13%. This happens all the time. Now you might say, okay, I'm going to pay off the card on time. I'm not going to carry debt. That's great. But if for some reason you did, you coming in with a strong credit score is already going to save you money there. And so when we add this up over a lot of transactions, right, mortgage, credit cards, auto loans, if you're looking for an apartment, we know how competitive real estate here in LA has gotten. I was reading that they were showing a chart of credit scores to qualify for apartment, like over 5-unit apartment buildings in LA County. And if you went back to like 2002, 2003, a lot of folks were getting in with below 600s. It was a lot more lenient. These days there's so much competition in many neighborhoods that many landlords are like, under 650, they're not even looking at it, you know? And it's interesting. But again, when we know what determines our credit, we can control it, and then we're in charge. So, I mentioned earlier that the credit score predicts the chances you're going to go 90 days late, right? Within the next 90 days. This is a little look at what the odds are. If you have a score over 800, the absolute highest, there's almost zero chance you're going to go, in their view, that you're going to go that late. Now, as we go down a little bit, we see, and these are all good scores, by the way, guys. These are all good, pretty good scores to have. We see the numbers drop, so you're a little bit more risky. Then you come down here, okay, 26 to 1, 23 to 1. What that means is they think if they gave you money and you're below 600, I think the number for 600 was around 12 or 13. They think if they gave you money right now, there's at least a 7 to 8% chance you're going to stop paying them almost immediately. And that's a really high risk, right, for any company to take. So the lower your score, the more of a risk they see of you doing that. Now, I want to ask a question, folks. Just ballpark, what would you guys consider to be a good credit score? If I were to ask you what's a good credit score to get good terms, good rates on loans, what are some guesses? Anyone? Sir?
750 or better.
Yes. Yeah. He's been to, no, he hasn't. Their presentation, yeah. 750 or better, that's exactly right. 750 to 760 gets you the best loan terms on mortgages, auto loans. Every credit card will approve you. With many mortgages, we do see, because the rates are so low right now, they're going down to 720 for the prime rate, as we call it, the best rate. When you go down to about here, 650 to 680, you'll find most credit card issuers will work with you, but the closer you get to 650, it's pretty much Capital One, and then maybe some of the subprime companies that don't give all the points and the cash back when you get to 640, 650, okay? For mortgages, usually you need at least a 620. The FHA and the VA, the veterans programs, do go down to 580, but there are obviously other fees associated with it, okay? And 620 is for most conventional loans for buying in areas like where we are here. And then when you go below 600, it's not fun. I mean, auto lenders, I think we do have, there are some who go to 560. A lot of the buy here, pay here. You know, the other ones, what's the other one? Your job is your credit. Your job is your credit in the sense that if you show you have a job, they'll give you the loan. But a 20% plus interest, it does, 23, it does get tricky. And, you know, if you drive down the street from where we are here today, go north a little, past towards Hawthorne and all, there's more and more dealerships along there. You ever go in there, and I know because I've had friends and family who've done it with bad credit, gone in there. You ever go in there like, yeah, you know, we can get you the car. No problem, come on. They just want to get you there and sit you down because why? Now that you like the car, okay, yeah, sir, it's going to be 20% interest, 18%, 23, okay? And that's what we run into when we go to these places. It's designed, it literally sets people up to fail, okay? It's terrible. But again, when we know about it and when we understand how to fight that and how to build better credit, we can avoid those challenges. Now, this is really interesting, okay? This is, wait a second. That's the one, okay, there we go. This is very interesting, okay? If you want to see, when you're talking about mortgages, okay, just what your credit score does. Right here, we've got a $700,000 home. Yeah, I'm sad to say around here that probably is. Not even 700, probably more. But sure, we got a $700,000 house right here. Let's say 10% down, right? We know not as many people are doing 20% down these days. So 10% down. Now, how much am I paying per month without property taxes, without insurance, right? How much am I paying per month depending on my credit score? You're over 760, 750, like this gentleman just said. You probably are into 3% or below that. And this is your monthly payment, $3,202, okay? Now you go down to maybe 700, 710. Okay, it goes up somewhat, $3,464. Now, we get down to the low 600s, mid 600s, big bump in the rate, okay? It may not look like a lot, but 3 to 4.25 is a lot. You're spending over $400 a month more right here. And then 580 and below, usually in LA County you wouldn't get financing on that if you're below 620, but the rates are high. But here's what's interesting, folks. Take a look at this right here. This is the $800,000 house, okay, the upgraded house, okay? Same interest rates, same everything, 10% down. The monthly payment, when having a somewhat lower credit score on $700,000, is the same, okay, as having an excellent credit score and buying a home for $800,000. So if we back up a minute, a person who has, let's say, a 640, 650, okay, and qualifies for this loan and buys this house at a lower score is going to pay the same amount every month minus property taxes as the person who buys a house for $800,000, okay? Now, I have a question. How many folks here would say we're in a relatively competitive real estate market, like people are trying to buy houses? Any thoughts?
Now they are.
Yeah, absolutely. Not the case like 9-10 years ago, right? But right now they are. So the issue becomes, let's say you find this house for $700,000 and you like it, okay? And then you have other buyers show up, and we know we're around here, Torrance, Hawthorne, all these areas, this happens a lot. Someone else shows up and says, hey, I'll give you $720,000, I'll give you $730,000 if it's a house they like, whatever it may be, okay? The person who has the stronger credit score and really wants that house probably is going to be able, because of the loan term, to afford that monthly payment, whereas the person with lower credit who's offering on the same house is going to run into a major issue, because if they go up another $20,000 and they really want that home, the lender's probably not going to go along with it because they're going to say, okay, your monthly payments are going to be above this, it's going to be too high. Or let's take this example. Let's say $700,000 gets you this house, but it's not upgraded, okay? Maybe the floors need some work. You need to put in some new things to the kitchen. You need to get some roof work done. All of these different things we run into, right? A lot of times you can find a house that has those things done for closer to $800,000, $820,000, $790,000. But if your credit's lower you're going to be stuck with this house, and you're going to have to go out and get contractors and get folks to help you and put it together, which anyone who's dealt with a remodel knows if you're living in the house and trying to fix it, it's not so easy to do, right? So that's what we're facing here, folks. And we're just talking about 1 month, right? This is on 1 month we're paying this, or for 1 month we're paying $400 more. Add that up over a year, $4,800, 2 years, 96. You can keep going, right? I'm pretty sure that every single person here can think of a better way to use that money besides giving it to Chase Bank or Wells Fargo or Quicken Loans or whoever you do the mortgage with. This is really, when folks ask, okay, why is credit so important? It's not just being able to buy the home. Okay, you can show up with a lower credit score and potentially buy a house. It's also about the house and how competitive are you relative to others on the market, things like that. You know, and we are even seeing realtors now, at least locally, when they're getting offers from a house, some of them are coming back and saying, hey, okay, you gave me the bank letter. I also want to know what the FICO scores were. Why? Because they're trying to figure out in their head, if this one goes up, if there's multiple offers, is this person going to be able to close on the home? Because they know if their FICO's higher, their monthly payment's lower, and they can afford more house. And literally, that's what they're looking at now. Now, I have a question. Does anyone here own a Kia? Kia, anyone? Oh, no one? Okay. I'm not going to offend anyone by doing this one then. Okay. What do I have on my left? What is that? Kia. What do I have on my right? Tesla. Okay. Let me move over. Same thing applies here, guys. With the low credit score, here a bit lower, okay? Here more like the 580 to 620. This is what you're paying, $705 a month for the Kia, okay? Good credit, $450, $556. Even here you can see, okay, for a $25,000 car, you're going to end up spending about $250 more per month, okay? For the same car, there's no difference. They're not giving you anything better because you came in with the lower score. If anything, they sometimes are giving you a less desirable one of what they have on the lot. So you're spending a lot more per month. But again, same dynamic here, folks, okay? Same things going on. This Tesla per month with the strong credit, this Tesla, which is $10,000 more, is going to cost you on a 5-year loan less per month than this Kia, which is $10,000 less. And maybe I'm just going out on a limb here. Not as many people are chasing after the Kias as the Teslas, right? Now, I know this is kind of a handful, a mouthful, right, to think about, that you can buy a car that's $10,000 more, right, for the same monthly payment if you have good credit, versus if you bought that $10,000 cheaper car with poor credit, you're paying the same amount. Same thing with the house. Now, I know this is kind of a tricky point. Do we have questions about that? Do folks want me to kind of go into more depth on this at all? Make sense? Okay, cool. Let's see what we have here. Now, here comes the pitch. No, I'm only kidding. We're going to go after this into what exactly determines your credit score. And this is a really involved part we'll be sharing more resources on this after we leave here. But this is the part that definitely I think a lot of people will have questions, and it's pretty technical. But before we go into that, which is how do you improve credit scores? How do you clean up bad credit? Okay, I want to give a top-level view because I want to ask a question. If I say the word credit repair or credit restoration, what do folks here think of? Scam. Thank you. Anyone else? The same. Yeah. Yes. Okay. Yeah. And you know what? I don't entirely disagree with that. I'm going to tell you why. I say this as an attorney who does credit repair and who sues the credit bureaus. I don't disagree with that. Here's the reason. Credit repair, the way it has been practiced for so long by so many out there, okay, including in this community and all over the country, it largely is a scam, okay? It's charging a lot and not delivering a lot of results, or telling folks things that is going to get them in trouble, like going and telling someone, hey, go say you were a victim of identity theft to get these bad accounts off your credit, which is illegal and people have been prosecuted for, by the way, both the credit repair companies as well as their clients. Going and telling people to do things that are going to put them in danger, right, that are going to set them back for a short-term gain of maybe improving their credit a bit. It's going to put them in legal trouble, and it's not going to resolve their issues. That's what a lot of credit repair has been, folks. Let's be honest. Like Tony and I have no interest in defending what goes on with that industry. But I'd like to say what credit repair should be, okay, or at least how we think of it, okay. By law, there's a big federal there's a federal law that really is the crux of credit repair. It's called, we call it affectionately, I suppose, the FCRA, Fair Credit Reporting Act. It was passed in 1971. It says a lot of things. It's hundreds of pages. There's 4 things that matter for everyone here if you want to understand what credit repair is, okay? There's a lot of requirements in the FCRA around your credit reports, your rights, if there's a mistake on your reports, what you can do. But there's 4 requirements that the credit bureaus and the companies that put things on your credit, the mortgage folks, the auto loan companies, the debt collectors, there's 4 big requirements they have to meet, okay? And they are, in summary, verifiable and compliant, but we would say complete, accurate, verifiable, and timely. What does complete mean? Let's say that you were marked 90 days late on a loan, and I see this all the time, okay? You were 90 days late on an account, but the previous month, they didn't mark you 30, they didn't mark you 60, they wrote an X or they wrote an ND, meaning no data. They didn't know. They're basically admitting they didn't know whether you were on time the previous 2 months. So even if, let's say that you were 90 days late, okay, let's say that you were. If something happened, work was slow, you've gone through a rough patch, you were 90 days late. But they haven't done that properly on the credit reports, okay? They haven't said that clearly. That's not only not accurate, it's not complete. Or let's say you have a collection, okay? You went to the doctor's office and insurance was supposed to cover it, but we know that insurance often doesn't follow through. Ends up in debt and collections, right? This happens a lot. We see this so much, it's just crazy. I know a lot of folks in this room have been through it. I've been through it, okay? And I'm an attorney who deals with this, I've gone through it. They go and they send a collection, okay? It appears on your credit reports. Your score drops. But you dig a little more, okay? And this is what we would do. When we look at it, we're like, okay, send us proof that the treatment you're claiming you did, okay, you did a checkup, you did a blood test. Send me proof that's what you actually did, okay? Or send me proof that you informed me that I owed this debt before you put it in collections, okay? Or send me proof that you told me about my right to challenge the debt before it appeared on my credit reports. There's so many little things like this that they often fall off on. Verifiability, right? A lot of the lenders, and particularly the debt collectors, they don't maintain proper standards, or they don't put a lot of effort, even in the era where we have everything computerized, right? They don't put a lot of effort into making sure things are verifiable. They're violating the law, okay? So it's not accurate, it's not complete, it's not verifiable. Last one, timely. Okay, we're going to go into this in a future one, in a couple slides, but there's a limit on how long things can stay on your credit report, and that gets violated a lot. We see it a lot. We filed a lot of lawsuits over it, and we continue going back to court over the same issue. These guys don't learn. Wells Fargo, big example of one that does. Portfolio Recovery, a big debt collector. They do this all the time. Literally hundreds, if not thousands, of lawsuits filed every couple of months against these guys for doing this, but they keep doing it. And so the thing is, we've got all these legal requirements, right, around credit reports. Now I want folks in the audience to give me a guess. If you were to guess, what percentage of accounts on credit reports do you think meet all of the requirements I just mentioned? They're complete, they have proof.
Less than 10.
You're in the zone. You're exactly in the zone. About 82% of credit reports contain multiple errors. Could be a really small error. Could be something like you didn't live at this address, or you owe $302 and they put $305. It could be that. But it could be really serious stuff like that was not your account. Okay, they mixed you up with someone else, you know? Maybe you have a relative with the same name, they mixed you up. Or maybe that is your account and they don't have proper proof that you agreed to this particular treatment, or that you agreed to a 21% interest rate, which they're charging you on this charged off credit card. Maybe you didn't agree to 21%. You'd be surprised how often even big companies like Chase and Amex don't properly list this, right? And so when we look at the fact that the majority of credit reports contain some sort of issue, then what we see is even if a bad account belongs to you, there's still so many requirements that have not been met, okay? I think it's pretty rare, honestly. I mean, and Tony can chime in on this. I'd say other than identity theft, probably 85 to 90% of the accounts we see outside of identity theft, they do actually belong to our customer in the sense, yes, the debt that resulted in the collection is theirs. Yes, that was their car, it got repoed. But then there's so many other mistakes, okay? There's so many other issues. And I've only touched on this law, okay? There's a lot of others. I mean, did you know if you're in California, okay, and you own a vehicle and the vehicle is repossessed, there's certain notices that you're supposed to be sent when you request them. Within 14 days of requesting under state law, you're supposed to get a notice regarding how much the car was sold for, how much it's worth now, if it was sold at auction, what it was sold for. They're supposed to provide proof of, basically proof of the debt, meaning the contract, all of these things. So even if it was listed okay on your credit reports, but they can't provide that information, now you might have a state law claim. And luckily here in California, there's a lot of laws that protect consumers, and those are things that operate to your advantage. Your home is foreclosed, okay? There's a federal law called TILA, another one called RESPA, okay? They govern everything around mortgages, and there's a lot of notices required. There's a lot of documents that have to be provided, and those things are not met. So basically, what we do, folks, in a nutshell, when we say credit repair, as it should be, is applying the law to your credit report to figure out how negative history, how negative items can be addressed. Now, if something meets every requirement, okay, it's verifiable, it's accurate, it's timely, all of those things, we're not going to tell you it can be removed. Legally, you cannot have it removed in that case. But most times, that's not the case. Most times, there's some sort of issue that something can be done. And even if there's not an issue, you'd be surprised how flexible some of these creditors are, We had a client not too long ago who was a couple months behind on a payment, okay? And they agreed to prepay the next few months. They agreed to prepay, personal loan. They said, I'm going to pay the next couple months ahead of time, before it's due, just to show you that I'm a trustworthy person. And they took the late payments off. They didn't agree to that on the first conversation. It took took some negotiating, but they can be worked with as well. They're in business to make money. And so both using the law and also using negotiation and persuasion, it's possible to address these issues. Now, I've said a mouthful here, folks, so please jump in. Questions, comments, objections? Okay, cool. Now, we've talked about these negative items and all of this, okay? We're now going to really go deep into what decides your credit score. So these are the 5 things that determine your score, and we're going to go in each of these. And if you understand these, there's no reason that every single person in this room, if they understand it and they apply it over the next year, the next 2 years, could really not enjoy a good credit score. We see it every day, okay? When you understand what's out there, you really can act intelligently and very strategically as far as how you manage it, okay? So, does anyone have a guess? What's the number one thing? If I was to pick one thing that decides your credit score, what is it?
On-time payments.
Payment history. Yes, sir. Payment history, okay? So these are the 5 factors, okay? We're going to go over each. Payment history is 35, amounts owed are 30, length of credit history is 15, types of credit used is 10, and new credit is 10, okay? But let's go into each of these individually. Payment history first, okay? Payment history basically means the following. Did you pay on time? Did you not pay on time? That doesn't just mean late payments. It means late payments, okay? Collections, when you paid very late. Charge-offs, when the account is written off. Repossessions, when you didn't pay your car. Foreclosures, when you didn't make payments on a house. Judgments, when you were sued in court, and that appears on your credit reports when you lose. Tax liens, where you didn't pay the IRS or the state of California or some other state. Those are all things that are considered payment history, okay? It's not just late payments, it's all of those things, because each of those issues results from what? Money was due 1 month, I didn't pay it. Money was due another month, I didn't pay it, okay? And that's what payment history is. But here's the thing to understand with these accounts, with all this negative history, right? I want to do a little exercise here. If you had a 60-day late payment 4 years ago, and then you had another one 2 years ago, do you think they have the same effect on your credit score, or one impacts more than the other, or some guesses, folks? Answer it for you. The 60-day late that was 4 years ago has far less impact on your credit. It does have impact. It does hurt you, but not as much as the one that happened 2 years ago. By the same token, okay, auto repo really, really damages your credit score. But an auto repo that occurred 6 years ago versus one that happened in September of last year, 5-6 months ago, there's a massive difference in the impact, okay? FICO reduces the impact of these negative events over time. So the 30-day late that happened 5 years ago does not hurt you like the one that happened a year ago, okay? Same thing with any type of negative credit item, okay? And since late payments are a common issue, I'll share some interesting information with y'all. A 30-day late payment hits your score for about 15 to 18 months, the majority of the impact. It still has some impact after, right? But we have a lot of folks come to us and say, hey, I had a bunch of 30-day late payments 3 years ago. And that's usually not the reason why their credit's not where they want it, okay? If they had come to us right when it happened, then yes, that's the main reason. But usually it's another issue, okay? 30-day lates are about 18 months. 60-day lates, most of their impact's about 2.5 years, 30 months, okay? 90 and 120-day lates, the whole 7 years, they hurt you, okay? They hurt you a little bit less after 4, but they continue to have a pretty rough impact. And I should know because I had 7 student loans that had 120 days late. So I can speak from personal experience. They really kick your ass, okay? They really do. Same thing with any of these. But the older, the less impact, the newer, the more impact, okay? And then obviously the more delinquent you are, right? A 30-day, who thinks that a 30-day late would hurt my credit score more than, say, a collection or a repo? If you were to guess, what do you think would hurt me more, the repo or the 30-day late? Exactly, exactly. There's levels of delinquency, okay? Small late payments hurt you a lot, but not as much. The big items, the foreclosures, the repos, the 120-day lates, the credit card charge-offs, the bunch of collections, the unpaid student loans, those are what really hit you. So it really comes down to how late you were, okay? How late you were, how long ago it happened, okay? And the biggest takeaway that folks should have here is, and this is very obvious, everyone who's sitting here knows this, it's easy for me to say, it's hard to implement, don't pay late, right? Okay? Try to set up auto pay, keep an eye on your accounts, but then we know life happens, right? Someone loses their job, okay, which I went through, okay? Someone goes through a divorce, didn't have that happen yet. But, you know, these things happen, right? And then you have to come back from it, okay? And then so the thing to keep in mind is that with negative items, there is, as we said, the legal process to address them, but the number one thing you can do is smart strategies to avoid them, and we're going to talk more about those later, okay? Now, the other thing I wanted to touch on is we see this issue a lot. As mentioned, we work with a lot of mortgage lenders. Folks are out buying a house, right? They get the offer accepted, which means they went to a lender, their credit was approved, all of these things happen, okay? And the lender comes back to them and says, hey, you know what? Your credit score was okay. You had the 640, so yeah, you're overpaying, but you want the house now, fine, you can do it. But they say, oh, you have a lot of debt, you know, you have some unpaid collections that are kind of old, a few $1,000s. And sometimes what happens is folks say, okay, you know what? Let me see if I could try to get my score up by paying some of those collections, okay? And does anyone want to make a guess what happens?
The score stays exactly the same.
Exactly the same, possibly, if you're lucky, or it goes down. It could go down, and I'm going to tell you why. When they look at an account, they look at the date of last activity, right? So date of last activity, okay, level of delinquency, date, okay, last activity date. Basically, they look at the last time there was a payment, okay? If you make a payment and the account stays on there, you're basically making the account more recent. Now, if you made a payment and got them to say, yeah, I'm going to delete the account, I'm taking it off, then boom, score goes up. But most times that's not what's happening. Folks are paying these thinking it's going to help the score. It either doesn't go up or it goes down because now they update it and say last payment made to 2020. So the sad thing is, for trying to do the right thing, you get penalized. And that's crazy to me. It's crazy, okay? But it's something that folks should know because we run into it a lot. So our advice is always before you're going to go into some sort of credit transaction, whether it's a mortgage, it's an auto loan, those are the two big ones, right? But even in general, try to pace yourself out 4, 5, 6, 8 months before and make sure your credit's in order. If there's bad items, you work on it. You deal with those issues, you pay down debts, you do these things, right? Because the last thing you want is to be scrambling around last minute, and then in that sort of desperation, you make a mistake like this and you kind of screw yourself over, right? That's what happens, and we see it a lot.
How long does it stay on?
The collections?
After you pay it off, after it's
Oh.
been like years and years.
Sure,
and you pay it off,
sure.
Now it becomes,
You exactly anticipated what we were going to talk about next. Right here, 7 years, to answer your question, sir. 7 years after the date of first delinquency, okay? So let's say that you had a collection let's say that you had a bill, okay? You had a credit card, and you stopped paying on it, work was slow, couldn't make payments, okay? You stopped making payments on that credit card around, let's say, December of 2012, okay? That's the first time. The last payment you made is December 2012. January 2013, 30 days late. February, 60 days late, and so on. 7 years after that first date that you missed, okay, or I'm sorry, the last payment, the December 2012, 7 years after that is how long they can keep it on there for, legally. That doesn't mean they follow that. A lot of times they keep updating that date and keeping it on for longer and longer. We see that all the time, and you can sue them over that. But by law, they're only supposed to do that for 7 years, okay? 7 years is legally what's allowed for collections and charge-offs. So that's if you had a medical debt, okay, 7 years after the payment was due with the doctor's office or with the dentist, you were supposed to do that, okay? With credit cards, personal loans, 7 years after, it's supposed to be removed, okay? Whether you had, so basically what we see a lot is, in the earlier example, December 2012 was the date, right? Now, sometimes that debt will go from the credit card company or the doctor's office over to a debt collector, okay? Then the debt collector gives it to another debt collector, okay? They're really playing musical chairs with this thing. And each time, it's like that telephone game we played when we were kids. The information gets a little messed up, some records are not included, some piece of paperwork is not provided, and that date sometimes gets changed. And these guys get sued over it all the time, okay? We've sued them multiple times for doing this. But those dates sometimes get updated and changed. But by law, sir, to answer your question, it should be 7 years for the charge-offs and the collections. Pretty much everything is 7 years, okay? Late payments, if I paid late in February of 2013, we're now in March of 2020, it should be off of there. It should not appear on there anymore, okay? Late payments is 7 years. Inquiries are not technically a negative item. Like you have to apply for credit, right, to get an inquiry. Otherwise, you're not going to have a good credit score because you're not going to be able to build credit. But inquiries stay on for 2 years. Judgment, 7 years. The only thing that stays for a really long time is a Chapter 7 bankruptcy. Okay, that's 10 years from the date you filed. So you had a lot of folks who filed around 2009, 10, 11 with the economic crash, with the downturn. A lot of those are coming off right now. But an interesting thing with bankruptcies, you can build a pretty good credit score about 2 years after a bankruptcy because those accounts are closed and you can start building new credit. So it is possible to rebuild. But, you know, folks are always concerned, hey, that's on my report. Certain lenders will not work with you with a bankruptcy, so they want it off of there. And there is a process for that. But yeah, pretty much everything 7 years is the date you should remember, except bankruptcies is 10 years. Yes, sir?
Just to be clear, so let's say I have an account that I didn't pay for 4 years.
Right.
And then I pay it.
Right.
And that reduces my score. How long, is that a new account, or is that the continuation of the beginning of the 4 years? Now I need 3 more years for it to get off, or since I reactivate it, does it continue for another 7 years?
Very good question. Very good question. So when you pay or settle an account, okay, let's say that you owed, let's say you owe $2,000 on an account, you pay it off, you settle it. The date of first delay, the date is not reset unless you go into a payment plan and default again. Okay, let me explain. Let's say you owed $2,000, right? And you settle it for $1,000, okay? And that's done. End of story. They closed it. That's it, okay? That won't reset necessarily the 7 years clock. But what happens is this. Let's say that you said I'm going to settle it for $1,000, right? And then let's say you said I'm going to do 2 payments of $500, okay? And you make a payment of $500, and then you miss the next payment of $500, okay? I know it sounds like I'm giving you a crazy scenario, but this happens a lot. If that happens, if you miss another payment, then you reset it. But if you just make a payment on it, you settle and close the debt, it's not going to reset it. So we have, all the time, we have folks who come in with a 4-year-old charge-off, and they want to buy a home, okay? And our goal is, okay, how can we get their score up? Sometimes it's the only negative item they have. We'll say, okay, go ahead and pay that, okay? Yeah, go ahead and settle it, pay it. They're not going to want the full amount, but go ahead and settle it for some amount. The account is closed. It's going to fall off your report in a few years. But the advantage of settling it or paying it, it's not going to continue reporting every month, right? Like let's say that you mentioned a 4-year-old account, okay? Let's say it's a credit card. Every single month they keep reporting that an account was charged off, okay? They keep saying that every month, and it's very active. It hurts your score. Now, if you were to settle that account, okay? You settle that account. Now, it's not going to report it's charged off every single month. They're going to stop reporting it. It says closed. And when it's closed, it's a lot easier to try to remove using the credit repair process, okay? And it has less impact on your credit because they're not marking charge off, charge off, charge off every single month. So on average, it does make sense in many cases to settle accounts. I know a lot of credit repair companies and others are like, oh, don't settle, don't pay them. No, we don't want to pay our bills. That's not really the truth. There are situations where it makes sense to settle the account, and it's not going to reset it as long as you meet the payment plan or the obligation that you entered into. Does that answer it, or?
Yeah.
Okay, good. Yeah, it's a very common question because a lot of times folks are like, is this going to mess me up more and keep it on here for longer? And the answer is no, it won't, unless you agree to like do 2 or 3 payments with them and then you miss one of those. Then you've gone delinquent again and then you're back kind of into soup, okay? But if you make those payments, you just paid in one installment, boom, good to go. It's not going to remove it from your credit earlier, but it's not going to keep it on any later, okay? And when the account is paid and closed, then there are certain reasons why it becomes easier to remove using credit repair. So that's one thing. So basically, we've got up here how long these stay on for, right? 7 years is the magic number that folks should remember. Anytime you're thinking back and you're saying, you know what, I think it was 6 years, it was 7 years, it feels like it's been a while, you should keep an eye on that. Because there's a lot of times that they don't follow the law on this, and we go and sue them over it because of that reason. So something to keep in mind, folks. Any other questions on this?
Are inquiries technically a negative impact on your account?
They do have some negative impact. They do have some negative impact. I don't want to call them a negative item, okay? Because you need an inquiry, right? Like you want to buy a house, you have to do an inquiry. They can't just give you the money. It's not. It does have an impact on your score, which we're going to go over. It does hurt your score a little bit, but I wouldn't consider it a negative item per se. I'd say if you have a lot of them is when it becomes a negative, okay? And we're going to go through that in a minute.
So if you were, I mean, you're still going to get a lot of them if you're going to be going from multiple mortgage carriers. They're all going to run their own independent one because they're not going to trust.
You're absolutely right.
Let me show you my credit score.
Yeah.
What are you worried about?
Yeah, and they'll never let you show it. You know exactly. The good news is, and we're going to go over that in a bit, within a certain time period, all the mortgage or all the auto loan inquiries will count as a single one. It's a short amount of time, but if you go to like 10 different banks during that time, you're going to be fine in the sense that they can run your credit, each one can run your credit, and you can decide who you want to go with, and you're not going to have any further damage. So we're going to go over that, but that's a really, really good question because this happens a lot. Nobody wants to go try to, buy a house and be like, yeah, Wells Fargo said they're going to give me a good rate. I'm just going to listen to the guy there and believe what he said. Like, no one wants to do that, obviously. And the good news is there's a strategy to avoid that, to avoid exactly that. So the next factor is debt, okay? The rough 4-letter word, when you owe money, okay, how much debt, how much utilization do you have? Now, I have a question for folks out here. Do you think if you had a big mortgage, let's say $2.5, $3 million, or you have an auto loan for $90,000, you went out and got a Mercedes S500 or 550, whichever one it is now. Anyhow, you got one of those, right? You've got all these big debts, okay? You've got the multi-million-dollar house, you've got the car. Do you think that causes you to have bad credit? Does that lower your score?
I would say it's your payment history associated to that, correct?
Precisely, it is. But would you guess that, okay, because I went and took that big mortgage, that in itself is hurting my score?
No.
No?
That's very debt to income ratio.
Precisely. And here's the thing. It's exactly it, Marco. Credit reports don't contain your income, right? They don't know how much money you earned last year. Okay, that information is not on there. I could have someone who bought the $2.5 million house and has a $90,000 auto loan, and they also have their own business, or they're a plastic surgeon up the street in Manhattan Beach and they make $1 million a year and they live up in PV in that house. Obviously, that person can afford it, right? Clearly, they can afford the multi-million-dollar house and all those things. Now, a person who made 1/10 of that amount might not be able to. But the bureaus don't know how much you earn. So they don't really hold your student loan debt, your auto loan debt, your mortgage debt. As long as you pay it on time, they don't really hold it against you in the sense that having a lot of that debt is going to hurt you. As long as you keep paying it, they're like, okay, cool. This person has the income to support that level of debt. What they hit you for is credit cards. And when I say credit cards, I mean store cards, charge cards, as well as regular cards, okay? The more spending that you have on those cards, or the more that you carry a balance from one month to the next and you don't pay it down, not only are you paying a lot in interest, okay, but that credit score is being lowered each month, not being lowered each month, but each month that you're going with too high utilization, you're using too much of the card, okay? You're running into trouble. Now, does anyone know, if I have a credit card with a $1,000 limit, what spending amount should I stay below? Like, if I were to spend a certain amount in a month, what number should I try to stay below on a credit card with a $1,000 limit? Any guesses? $500? $200?
I'd say you wanna stay under whatever you're gonna make in a month, right?
Yes, absolutely that. You absolutely want to do that for sure. Otherwise those late payments are coming back, and we're back in slide number 1. Yes, absolutely. But number 2, exactly. Remind me your name, sir? Daniel. Exactly what Daniel just said. If folks didn't hear Daniel, he just said 30%, $300. You want to try to stay. You want to try to stay below 30% of your limit on the card. So you have a $1,000 limit. You want to try to spend under $300 each month. Ideally, even better, under $100. Okay. You want to try to keep your spending relatively controlled and low. Now, that doesn't mean that one month you spent more. It's Christmas. You went and bought stuff. Okay. Even if you paid it off, yes, the balance was higher. That's not really an issue, folks, unless you're applying for a mortgage in January. Then it's a big issue, okay? But doing that once in a while is not an issue. What becomes an issue is when you consistently overspend on your cards, you carry big balances, you spend more than that 30%, okay? If you can try to maintain a habit on all of your credit cards that, you know what, I'm going to try to keep my spending below 10% of the limit. And let's say you spend a bunch on the card, okay? You go make a big purchase, $1,000 card, you go to Best Buy, buy a new computer, buy some other stuff, spend $500. One of the best things you can do, I'm not saying not to spend a $500, pay it off as soon as you did it, like ASAP, okay? If you spent that $500, try to pay it off a few days later. Not because of interest, but for another reason. We don't know the exact date that the balance from the credit card is going to get sent to the credit bureaus, right? They don't disclose that. We have a general idea. We don't know the exact date. So the best way to avoid that risk where you spent a lot on your card and then you want to preserve your score is to try to pay it off. Anytime you make really big purchases, kind of make a habit of paying it off sooner or very soon after, okay?
So do they watch the trend on how much you're spending on your debt allowed or credit allowed?
So they don't in the sense of credit scores. So like if you had a big spending month 2 months ago and then now you don't spend a lot.
Or for instance, I have a credit card
Yeah.
with great airplane miles that
Right.
I put all my gasoline, all
Sure.
my groceries on. So
Sure.
say it's $1,000 card, I'll probably hit $900 every month. But
Right.
that's the goal is that was already budgeted money.
Right.
So,
Right.
but you're saying that's actually a negative.
It can be. I'm going to tell you, this is where it gets tricky, folks, and we're going to stay on this one for a while, okay? It can be. So ideally, if you spent that $900, and I already know you do this, so you spent that $900, and when your payments were due, you paid off the $900, right? Which is ideally what you do. That way you're not paying interest, okay? But depending on the date it was reported, you could run into issues. So let's use one of my cards as an example, okay? I have a card with Chase Freedom. The due date on the card for the previous spending from the previous statement is the 2nd of the month. Okay, so March 2nd, I just had to make a payment. Okay, so obviously I pay it off every month. That's what I do. The 10th of the month, they generate a statement. Okay, statement basically means what have you spent on the card, where's your spending at the moment. Okay, now soon after that statement date, we don't know the exact date, they don't disclose it, but it could be as little as a day after, it could be as much as a week or 10 days after. Somewhere in there, they report your balance. Okay, so that $900 you mentioned, if that $900, let's say that it fell on the 1st of the month, I mean, before the 1st of the month you had $900, you paid it off, okay, cool. Then let's say that your statement was issued on the 10th, okay, and you hadn't spent much on the card at that time, okay? Maybe they report your balance on the 12th or the 13th, something like that. No issues. But let's say that you spent a bunch of money on the 8th, okay, the 8th. Statement is generated the 10th. Now that $900 could show up, okay, because they're going to report right after the statement, okay? And so you can kind of get an idea of this. If you follow your credit scores, and we're going to share where to do that on Credit Karma and these other apps, you can see when the balances are changing, and you can kind of hone in on when are these guys reporting it. You can like backtrack and find that out. But it's tricky to do that. It takes, kind of paying attention to it every month. So our advice is generally, as of the date your statement is generated, in my example, the 10th of the month, try to keep your balance below 10%. or below 30 as of that date, okay? And if you have a big purchase right around that time, just try to pay it off ASAP. Like that statement date, and you know it for each card, they tell you what it is. Really keep an eye on that date and try to keep your spending around that date on the lower end. If you can do that, you're never going to have any issues. Yeah, that and just pay off the big purchases. And I know it's frustrating because they don't really disclose these things and you're like, crap, I spent a bunch of money, but I always pay on time and now my score dropped. And for that reason, that's why I say the best thing you can do whenever those big purchases happen, try to pay it down ASAP. Yes, the due date is the next month, but if you can pay it even sooner, if you really are concerned about your score, or let's say you're applying for a mortgage in a month or two and you have to make a big purchase on a card, in that case, just try to pay it off as soon as you can. And that'll really help. Will really help.
Coordinate the amount that you used and when you pay it. So if you have a 900
Right.
bill
Right.
and you're going to pay it off within a month's time,
Right.
but it has been, you generated that 2 days before they actually send in the amount that has been used.
Right.
It doesn't coordinate when you paid it.
It doesn't. You're absolutely right, it doesn't. And so you'll randomly see, we see this a fair amount actually with folks applying for mortgages. They'll randomly have always paid on time and they're going to pay off the balance. They're going to pay off the $900. But you're absolutely right, Marco. It can be a random date when not a random date, but if the date that it's reported each month is a date when you had a high balance, yeah, they don't coordinate it. So they'll mark you as having paid on time, but it will show a higher balance for that month. I've seen it happen myself.
It also shows the amount that the payment is also due, like 900.
It does.
But if you paid it all off, then there is no amount,
Right.
amount that's on there. So how can they do that legally? Because why?
Sure.
How can they do that?
Sure.
Because you've already paid it off, or you just initiated the 900.
Right.
You just started with that.
Right.
But you're going to pay it off before the actual. You're not going to roll it over.
Right. Right.
So how can they actually put that amount plus the minimum amount that's supposed to be paid and say paid on time, when in actuality there is no balance?
Right, right. I see exactly what you're saying. So you have two laws that are in play here, right? Because I talked about the Fair Credit Reporting Act a few minutes ago. The law that kind of controls what you're referring to with credit cards, Fair Credit Billing Act. And basically, it puts a lot of restrictions around, okay, interest rates and things like if you have a disputed charge. But it specifically says when it comes to credit reporting purposes, it gives them a pretty wide leeway that they're required to report accurately, but as far as the date that they kind of pick your balance or that they put it, as long as it's a consistent date each month, that in itself is not illegal. I agree with you that it misrepresents. I totally agree with you. It's not fair. I completely agree. But that in itself is not illegal. And because we run into this issue so often, right, where folks always pay on time, but they had a high balance as of that date, unfortunately, there's no workaround. If you're in the middle of a mortgage or an auto loan, you can ask for a rescore and be like, hey, guys, I paid off the balance. It's paid now. And they can order your credit again and do that. And if you're in a mortgage, you should absolutely ask for that if that situation arises, because they can't charge you for it and it's something you can do. But month to month, they can report as of that particular date. They can do that. And it's not fair. I agree, because I had it happen to me and it pisses me off. But again, they can do that.
It's not accurate. That's
Yeah,
my point.
and I would agree with you. I think it misrepresents what's going on, but they're allowed to do it, unfortunately. As long as they say you paid on time, they're allowed to do it. So that is the challenge we're dealing with. But obviously, we know these rules are not really fair, right? So if we know that, we kind of have to figure out how can we work around it, right? How can we use it to our advantage? And the best thing you can do is paying off those balances in a near time frame, as soon as they happen. That's my experience, okay? And then along these lines, it's not just about paying down balances. You could also ask for a credit limit increase. Let's say you always pay on time. You have a $1,000 limit, okay? Capital One card, $1,000 limit, always paid on time, okay? It's been a year. You have not spent too much on the card. You use it properly. We recommend just calling them up and saying, hey, guys, raise my limit. Let me spend a little more. Let me give you more money, because remember, they're making that fee each time you make a purchase, right? They're charging the vendor for that. So let me spend a little more, increase my limit, and that can help your score, okay? That's definitely something that we recommend for some folks, is if they have low limits, even if they don't have a lot of spending, just raising that limit a little bit can boost their score. And it's an immediate hack. Like if they agree to it, within 30 days it'll show the higher limit and it'll bump your score up. So a lot of times when folks are going to apply for a mortgage, about 3-4 months before, if we know that their credit card has always been paid on time, we're like, hey, listen, you use this card well, you've had it for a while, call these guys up and ask them to increase the limit. And most times if you have a good record, they'll do it. And that will help the score. Now, the other thing that I want to cover, okay, we're going to go over this again later, but I think it's an issue. Who's heard of what we call trade lines? Trade lines, anyone? Okay, good. You guys haven't gotten exposed to the scam. Basically, we know that a lot of folks can't qualify for credit cards or they want to improve their score, okay? So you have all these folks out there selling what they call trade lines or selling accounts, and they say, hey, Daniel, I'm going to add you as an authorized user to my credit card, okay? If you pay me, I'm going to add you as an authorized user. And they go get folks to pay them hundreds or thousands of dollars to add them to these cards because they tell folks, if you get added as an authorized user, it's going to improve your score. And there's truth to that. Being an authorized user on someone else's card, someone who has good credit, who uses the card properly, they don't spend too much, they've got a good limit, becoming an authorized user will help your score. But here's the thing. The bureaus, the credit bureaus, and all these guys are aware that people are doing this. So now they started looking and saying, okay, is there some kind of a family relationship? And they can get all that data, obviously. Is there some kind of relationship between these two people? They might even contact the card company and ask them, is there a relationship between them? And if there's not, then most of the credit scoring models these days, including the mortgage one, will limit or eliminate the impact of that account, okay? So they will go and say, okay, you know what, Marco added someone to his card, okay? You added someone to your card because they needed some help with their credit. But let's say it's one of your buddies, it's not one of your relatives. They will go and call and say, okay, what's the relation to this person? And most times the card company would ask you that, or they'll do that. Or they'll look at other data. And then they'll say, okay, you know what? They're not related. We think this is an authorized user, some sort of scam, quote unquote. And they will deliberately exclude the formula, FICO, will exclude that account from being considered on your credit reports because they don't think it's a legitimate account where someone is helping their brother or their sister or their mom or dad or their son or their daughter, you know? If they don't think it's a legitimate situation like a family relationship, they'll eliminate it. The credit bureaus. The credit bureaus and FICO.
Say it was an employee or business partner.
Employee and business partner, you know what we have found is in some cases that'll work. In some cases it will work because a business credit card is treated a little bit differently. That can work. But when we have a personal card, like the regular ones you get from a bank, okay, business ones they do treat differently. That's a really good question. The regular ones, a lot of times, the FICO formula will automatically remove that account. Because we have folks who are like, hey, they went out and bought the trade line, which I don't recommend, okay, but they went and bought it. And they're like, why isn't it helping my score when I got the mortgage? Because the mortgage folks knew that this account, or the other thing that happens, people who sell these trade lines, okay, there's certain patterns with the account. So let's say that I have a card and I add all these authorized users, right? They have your name, the name of the guy who has that account where he's adding people. They have that guy's name flagged. So if you get a card with that guy's name on it, they're going to automatically discount it because they know that he's someone who sells access to his credit. So they really are going in depth. They're not just using the reports, they're using public records, all kinds of things, because we're in the big data era, right? So they're really going deep on it. And the reason I'm mentioning this, guys, is you want someone to add you, figure out if you have an immediate relative who has good credit, ask them to add you. They don't have to give you the card. They just have to put your name on there, and they can keep the card in their drawer. Your name's on there, it'll help. But if you don't have a close relative who has it, in our experience, when it comes to like mortgage and auto loan time, it's not going to help you much because this is only the last 3 or 4 years they've really gotten aggressive with this because too many people were doing it and it was kind of distorting the scores. They really started cracking down. So don't pay anyone to add you to a card. If you have a relative who has a card with good history, ask them to add you. Otherwise, don't even bother, you know? Don't even bother with it. The last one, okay, spouse, right? Now, this is a tricky one to follow, okay, for all the obvious reasons. If two people are married, you say, are we going to have a joint account? Are we not? We're not against joint accounts, by the way, okay? What I want to highlight is one of the risks, which is, and we have this with a client right now. He had a few collections. We removed them, but his score is not going up as much as he would like because his wife has a card with Discover and another with Amex, and it's a joint account. They opened them together, and the balances are really high, and she spent more on those cards. She's trying to pay it down, but it's kind of difficult. You know, it's not always easy to do that. And his score is not improving as much as he would like because It's a joint account, okay? Now, obviously you can contact them and ask to be removed and all of those things. You can do that, that is legal, but it's something to be mindful of when we have a spouse or some situation like that. You really want to be mindful of the other person's credit habits, because if one person's spending a lot, they're not differentiating, oh, you know what, the husband is spending too much, we're not going to blame the wife, or wife is spending too much, we won't blame the husband. No, they're blaming both of you. It's both of you are in that boat. So we see this a lot when it comes to mortgages specifically, okay? You'll have one spouse who, let's say that, this is the more common situation, both people want to be on the mortgage, right? You know, both of them are like, you know what, we're buying this home together, we both want to be on there. But one spouse, okay, maybe the wife makes more money and she has less credit card debt, okay? Then let's say the husband has a bunch of credit card debt, okay? And he also wants to be on the mortgage. All of that is going to count against them, both when they're borrowing, and it's also going to lower, basically what's going to happen is this, he's going to have a lower credit score. Now, if, let's say the wife, she has 3 credit scores, right? This part's complicated, so I'm going to do this slow. Let's say the wife has really got a 720 with Experian score, 730 with Equifax, 740 with TransUnion. Pretty good, right? Pretty good scores. She get a pretty good deal, right? They're going to look at her middle score, okay? Her middle score is 730 with Equifax, remember. They're not going to use her higher score or her lower score. The middle one is what they're going to use. Then let's say her husband has lower scores, okay? Let's say he has a 640, 650, and 660. 640 with TransUnion, 650 with maybe Experian, and 660 with Equifax, okay? Now, they have to decide, they're on the mortgage together. They have to decide what interest rate they're going to give you. Which score do you think they use to decide that interest rate? The lower one, yes, sir. They take each person's middle score. So they take the wife's middle score of her 3 scores, the husband's middle score of his 3 scores, and whoever has a lower one, that's the one they're using for the loan. Because they're saying that person's the weaker link, they're a bigger risk. Kind of ridiculous if you ask me in many ways, but that's what they do. They'll say, okay, he has lower credit. You know what? We're not going to give you the rate we would have for a 730 because she had great credit. We're going to penalize you because the husband has lower credit. And so in these situations, you can still buy the home, but it could make sense to leave one person off the mortgage. Of course, the situation there is, okay, if you need both their incomes to buy the home, then it gets tricky, right? So the point I'm trying to make is this. When we have spouses, and it's a sensitive conversation, I understand that. When we have spouses or people in a relationship, kind of being on the same page when it comes to spending on cards and finances, I don't think I'm surprising anyone when I say that's important. And it becomes really important when you're making these type of decisions because it can create some serious drama, you know? I mean, one person might be fine that their husband or their wife was spending more on the card, but when they go do the mortgage and they find out that's really pulling down the score, then they're mad at the other one and it creates a lot of tension. So we always say just having clear communication about that, and if you're going to spend on cards or chase points or something, just really having a strategy, you know, kind of avoiding someone racking up balances and doing that sort of thing is important.
Can you just get a mortgage with the person who has the best credit and then the other person just be a contributor?
You can. There are some restrictions around that because they're only going to use, they could be contributing like with the down payment and stuff. That's fine. That's totally fine. But if you want to use their income, like let's say that you're buying the house for $700,000, right? And we know that, okay, you want a mortgage for, let's say $560,000, okay? You want to put 20% down. So let's say that they want to see maybe $160,000 in income, 150, 160, okay, to give you that loan. If that person, the one spouse is left off the mortgage, they won't count their income towards the mortgage qualification. So they won't count their debt, but they also won't count their income. So let's say that spouse I'm leaving off the mortgage makes more money. Let's say they make $100,000 a year, and the other spouse makes more, something in the range of 50 or 60. Okay? If we leave the person who makes $100,000 off because they have lower credit, that income is not going to count towards the mortgage. They can put money for the down payment, that's no issue. But when the mortgage folks look at, can this couple afford this house, they're going to say no because that person's name is not on the mortgage. So that's where it gets tricky because I see this all the time, you know, Marco, I see this all the time. One person makes more money and they have lower credit, which is, it sounds weird to people. They're like, wait, they make more money, but yeah, okay, maybe they spend more, they were less responsible, they have lower credit. They're not legally allowed to consider the income if there's no, you can get a down payment, but you can't consider their income when looking at whether you can make payments. Now they could be on the title, okay? They could be on the title of the house that are technically a co-owner, but when it comes to trying to qualify for the mortgage, the bank is going to be like, look, we need them on there. you know? So it does get tricky. It does get tricky. But the best solution in these cases, as we always say, is obviously if we planned ahead, then we can kind of work through these issues, right? All right, folks, next one. Length of credit history. Okay, this one is relatively simple. Okay, this is relatively simpler. The longer your accounts have been open, the better it is. And this is really where this comes into play. Okay, if you have credit cards, you'll say you had a credit card that you opened 20 years ago, right? 2000, you opened a credit card. Okay, you got a bunch of those, or you have another one you opened 2004, 1998. These things that are a long time ago. Having those older accounts on the credit report, it helps your score. Why? Because you showed them you could stay responsible for 16 years, 20 years, 30 years. And they did a study. Folks who have over a 780 credit typically have one account open for at least 17 years, okay? So really it comes down, part of it's age, obviously, like, you know, I couldn't be 25 and have an account open for 17 years unless mom and dad added me to one of their cards, and then even then they kind of don't treat it the same way, right? But so part of it's age, but part of it is also just consistent behavior. Keep a card, get a card, keep it open, use it once in a while. And this is kind of the rule that I have, right? Because people say, oh, I opened this credit card years ago. I don't use it anymore. I don't need it, okay? Maybe you have a card with Sears, which barely exists today, right? As we know. And you're like, okay, what do I do with the Sears card? The trick is this. If you can use that card once in a while, maybe once every 6 to 9 months, it'll stay open and it'll continue to report to the credit bureaus every month as being on time, even if you don't spend, and it'll help your score. So a lot of times, folks who have really good credit, it's not so much that they do have accounts active. They have 3, 4, 5 accounts, but they've just got a lot of these old credit cards they just keep in their drawer, use them once in a while, and that just gets their score up. It's one of the best ways you can keep your score up is doing almost nothing, which is don't call them and close the account. Okay? Keep an eye on the payments. Like if there's a yearly fee or something and you don't use it, then sure, you can close it. I get it. But if there's no yearly fee, don't say a word to them. Just keep that card open. Use it once in a while if you can, and it'll help your score. But here's the thing. A credit card doesn't fall off your credit report when you close it. Okay? It stays on there. It typically stays on there for 10 years after you close it. So if you do close it, it's not like it's going to crash your score. It'll benefit you for a while. But if you somehow kept it open for decades and decades, it'll really continue to, over time, help your score, right? And that brings us to the third one, which is you need to call Warren Buffett at 602-93. I'm just kidding. I don't know his number. Okay? We say Warren Buffett. Why? Warren Buffett's obviously a financial and investment guru. He also has talked about this publicly. Some might say it with bragging that he has a very good credit score. I'm sure no one is shocked to hear that Mr. Buffett has good credit. What you need is you need your own Warren Buffett, okay? Remember I mentioned authorized user? If you have a relative, a close relative or someone in relation to you who has cards that have been open for a long time and you're trying to improve your score, see if they can add you to a card. See if they can put you as an authorized user, okay? And we see this sometimes. You see some of these kids are starting college and mom or dad has had this card for 16 years, 14 years, 20 years. They don't give them the card. They just add their name and keep it because you don't trust your kid with doing something like that, okay? You don't do that. They just add them, and that kid's already building a good credit score. So
Does that affect the other party in any way?
it would if they give them the card. If they give them the card and then Junior goes out and spends a bunch of money and racks up a bill, and then the utilization goes up, there's too much debt on the card, then yeah, it would. But most times what you do is you don't give them the card. You just call the company and say, hey, I want to add them to the card, okay? Added them to the card, done. And then it starts appearing on their credit reports. But you don't give them the card physically. So that you don't give them access online or give them the card. They can't spend on it. You just put them on there or they put you on there and you benefit. That's what you want to focus on.
And would you want them to use their oldest line of credit?
If you can, ideally, if you can, yeah. I mean, if I'll tell you this, and the oldest, and also if there's a high limit. If you have an American Express card from like, I don't know, 2004 even, let's say 2006, whatever, with a $10,000 limit, that's a terrific card to add the kid to, or to add any other relative or someone you're trying to help. If you're trying to help, your brother or your sister buy a home because they've had credit challenges, or you're getting help for yourself. Yeah, the older the card and the higher the limit, the better it is. Absolutely. So this is one of the strategies that you'll sometimes see some folks who, they only have 1 or 2 accounts and they're pretty young, they're 21, 22, right? But they've got really good credit. A lot of times it's because one of their parents put them on a card and they really helped their score. It doesn't have to be a parent, okay? You can go, you ran into credit challenges like I did, could have called my sister up and been like, hey, She wouldn't have done it, but I'm kidding. Could have called her up and said, hey, can you add me to your card and let me benefit from your history, okay?
So this technicality, they don't go further in to say, this guy was just added to his parents, and he never used this card, he
they don't.
doesn't buy anything,
They don't,
or
no.
anything like that.
They don't. They do not look at that. They look at the first part, which is, that was it mom and dad or a brother or sister? Yeah, they look at that. As long as that relationship is there, they don't dive further in.
Okay.
Where they really go in detail, Marco, is when looking at whether that family relationship is there, right? As long as it's there, they don't really care that they don't use the card. As long as it's under good.
Technicality that
Yeah, exactly. So if you have someone who you're related to has great credit and can add you to the card, boom, done. And it's kind of unfair because you have a lot of kids who didn't grow up with, rich mom and dad to put them on their cards, okay? Like a lot of us here in general did not have that type of situation at home, okay? So you didn't have someone to add you to the card and then some kid comes in and mom and dad added them. It's kind of unfair. For sure it's unfair. But at the same time, we can use that to our advantage if we have a relative who has that good credit and put them on there. Yeah. Now, mix of credit, okay? The more different types of credit you have, the better. What do I mean? There's two broad categories of credit, okay? There's revolving, which is credit cards basically, store cards, credit cards, and then there's installment, which is everything else, okay? So credit cards, why do we call them revolving? You didn't borrow a fixed amount. You didn't go to Citibank and be like, hey, you're giving me $1,000, okay? They might have a limit of $1,000, but you can choose what you spend and what you pay each month to some degree. So it's called revolving, okay? Everything else is considered installment. Mortgage, student loan, auto loan, car loan, yeah, all of those, okay? Those are all installment. Ideally, guys, you want a mix of revolving and installment, meaning if I have a few credit cards, maybe I've also got an auto loan. Maybe I've also got a mortgage, a personal loan, what have you, okay? If I have a mortgage, hopefully I also have a credit card. Having that mix, it kind of shows them that you're good at using different types of credit. Because what happens is, you could have a mortgage and they go tell you, okay, pay, $2,200 a month on the mortgage. You have no issues. You pay it on time. But then you have a credit card where they don't tell you can only spend this much, besides the limit, and someone goes and spends the max every month, right? What they're looking for in credit in this part is basically they're trying to see that you can responsibly use different types of credit, okay? That's what they're looking for. But this raises a question because folks might say, okay, let's say I have a couple of credit cards. Maybe I've got 3 of them, right? 3 to 5 is ideal. I've got a few credit cards. They're like, what? Or they're like, Shiva, are you asking me to go out and get a loan to have a good credit mix? And it's a very fair question. The answer is, it depends. If you're looking to buy a home, okay, if you're looking to buy a home and spend the amount of money that a house costs, it could actually make sense to get a small loan, and I'll tell you how this is done, a really small loan, just because the loan amount does not matter. What matters is the loan, and get it on your credit reports, and then pay it each month, and have that on there, and have it boost your score. Okay? It's not mandatory by any means. If you're not looking to make a major purchase, specifically a home, in the next 24 months, I would not worry too much about this. If you've got a few accounts, cool, leave it the way it is. But if you are looking to make particularly a home or even an auto purchase, then you want to focus on this mix. How do we create that mix, okay? I would never tell someone go out and buy the car you were going to buy in cash, go pay interest on it so you can build your credit. That's not good advice at all. But there's companies out there that have accounts. You can get them for as little as $20 to $25 a month. They'll basically set aside money for you. Then you make a little bit of a payment each month towards the money they set aside. And they report that to the credit bureaus every month. And it appears as a loan on the credit reports, right? And because it appears as a loan, now they're like, oh, wow, he has mixture. He's got a mix of different credit accounts. And the score goes up, okay? And so we've had a lot of situations where folks might have, say, a 700 credit score, right? And they've got 3 or 4 credit cards. They always do well with it. But they don't have any mortgage, any auto loan. If they just had 30 to 40 points higher on that, on their credit score, they probably could save a couple $100 a month. So what do? We tell them to go find one of these products. Self-incorporated / self-lender is one of the biggest ones. And you guys will all be getting our free book, so you'll have it in there. Self-lender. They basically just get one of those accounts for a couple $100, make small payments on it for like a year or even 6 months. Score goes up, and now they've saved on their mortgage. So I don't recommend opening these type of accounts unless you have a goal in mind, like I want to buy a house, a car, something like that. But if you do, doing something like that can help the score.
There's a lot of companies who say come and get furniture or car,
Right.
so you can get your credit.
Yes, yes, they do that. And it's crazy, right?
Why are you gonna buy something
Yeah.
so big?
Yeah,
Get yourself in debt, now your
Exactly.
debt to income ratio has gone,
way up.
so you don't qualify.
Exactly. Yeah. Now you tried to get one good thing done and you shot yourself in the foot. That's exactly it, Marco. And people go to the car dealer. Well, you know how the car. I mean, no offense to any of the car dealer guys, but we work with a lot of them when their clients have credit issues. But people go in there and they know that people are trying to improve their credit and do these things. So like, hey, buy a car loan. But the thing is, if you don't have good credit, the auto loan rate's already going to be crazy, right? It's going to be high. Yeah, no, I would never recommend it. Self-lender or they changed their name to self-incorporated. I don't know why. They had an existential crisis or something, but they changed the name, okay? They let you do this for $25 a month for a year. So they'll take $300, put it in a savings account. You don't have access to it, okay? $300 is sitting over here. Then they come back to you and they say, okay, we set aside $300 for you. Pay us $25 a month, 25 times 12, $300, okay? Each month that $25 gets reported as a loan. At the end of the 12 months, they give you back the $300 minus some interest and fees they charge because of doing this. They'll probably give you back around $280. So for a cost of about $20, $25, you built yourself a pretty decent, you boosted your score pretty decently within 5-6 months.
Do they report to all three?
They do.
bureaus?
They do. Report to all three bureaus as an installment loan. So they're really useful.
Does the value of the loan change the value of the points you gain?
No, that's the good thing. It does not.
So for $300,
Yes.
we can bump it, what are we talking, 15 points, 20 points?
I'd say more than that. I'd say you should aim. I mean, it depends on how high your score is, right? If you already have a 740, I don't think it's going to do as much for you because you already got a loan. But if you have like a 640 or a 540, we've seen, if I go back to the last maybe 3-4 months, I've definitely seen people that came to us who had that 580 to 620, They started seeing bumps in their score within 3 months. And I can say from previous years, from say 2019 or 18, when they had it for 7-8 months, that's the real sweet spot, when you start to see that 40-50 point bump. So like, if you're buying a home in 2 months, I wouldn't necessarily recommend it, okay? But if you've got 5-6 months, yeah, it really helps the score. Because for what, $20, $30 of interest, you saved a couple hundred, you made up for it multiple times on 1 month of car payments or 1 month of house payments. So it's a good product, because before they were doing what Marco just said, they were like, oh, go buy a car. They say that to people all the time. I hear it all the time. But this is a cheaper option. This is a cheaper, more effective option, because all that matters is you pay it on time and it's a loan.
Got it. So you can do it for each spouse.
Absolutely. They typically make you open an account separately for each person. Like, it's not like authorized user. But yeah, we've had cases where both spouses did it because they both had bad credit, or one did it. Or maybe they had okay credit, but they didn't use much credit, and so they did this. Variety of situations. I mean, it's good for people who are new to credit. It's good for people with bad credit. It really is a good tool, because credit cards, you can get a secured card where you give them a deposit. Or you can go get one of these, I don't recommend it, but Credit One or one of these subprime cards. But nobody wants to go and get an auto loan or go to one of these cashing places and get a payday loan. You don't need to do those things. The self-incorporated self-lender credit builder account is really kind of the hack that gets you over when it comes to that. A lot of folks who are buying a home and fall in that range of like 640, 650 up to maybe 690, if they've got 5 to 6 months, this is one of the things we tell them to do, besides maybe a little credit repair, is kind of use this, get the score up, boom, save on the mortgage. Yeah, it's pretty cool. Now, here we go. The one that we were just talking about, inquiries, okay? Inquiries, 10% of your credit score, all right? Inquiries is when I go apply for credit, when I go apply for a credit card, when I apply with the mortgage lender, the auto lender, any of those, you're signing an agreement, or you're signing a piece of paper or checking the box usually saying, yeah, you can pull my credit. You're agreeing to let them do that, okay? Now, this is where it gets a little tricky, so we're going to focus on this. Auto loans and mortgages, very specific type of credit, right? If you were buying a house, I think everyone, if you're buying a house, how many lenders would you think you should apply with? Anyone? 10. Okay, 10. Wow. 12, okay, cool, yeah. 14? yeah. So more the better, okay? More the better. I mean, you go in the range of 6 to 10, I think you're going to get a pretty good idea. There might be one hiding somewhere who has a better rate, but usually not. You get 6 to 10, you're going to know. But then folks are like, okay, 6 to 10 credit inquiries is going to destroy my score. Not if you do it in a certain way, which is auto and mortgage loan inquiries. mortgage specifically, if you do, it depends on the version of FICO being used, but I can tell you with certainty, we know this for a fact, if you do all of them within 15 days from the first to the last mortgage application, mortgage inquiry, they're all going to count as one. So March 1st was Sunday. If I went to Chase on Sunday, okay, and I said, you know what, I went online, I applied for a mortgage, they pulled my credit. I go to Wells Fargo on Monday, I go to Guaranteed Rate on Tuesday, B of A on Wednesday. As long as I keep all of those applications within that 15-day period, a 15-day period, as long as I do that, they're all going to count as one, as long as they were only mortgages, okay? So if you went and applied for the 12 mortgages or the 14 or the 10 mortgages, in that time period, all of them are going to be a single inquiry, okay? You might be saying, oh, it's hitting my credit, it's hitting my credit. Well, when you look at the version that they use for mortgages or they use for auto loans, they're all going to be counted as one when they score it, okay? So the point is, going and buying a house, which is the biggest purchase we probably make in our lifetimes, nobody wants to go and do that with saying I applied for one lender. You know, my brother-in-law is a loan officer somewhere and told me, yeah, come apply with me and I'll do it, okay? Nobody wants to do that. Everyone wants to know they're getting a good deal. And you can have the confidence you're getting a good deal if you apply with more lenders, as long as you do it in that 15-day time span. Same thing with auto loans, okay? Maybe you go to the dealer, apply for a few lenders with them. Then you go to your credit union or your bank, apply for a few. As long as you keep it limited to that 15-day period, you're good. Now, why do I have these other numbers up there like 45-day? There are newer versions of FICO. The newer versions of FICO give you 45 days. So all the mortgage applications within 45 days are going to be counted as one. But a lot of lenders are only using the old versions, guys. So that's why we say 15 days. Because you want to be on the side of caution that, okay, everything within 15 days counted as one inquiry. You really want to focus on that. Okay, so you absolutely should shop around because we work with a lot of mortgage lenders. I love them. They're great. But we also know, you guys are laughing there, that's a mortgage lender. You know, but we also know that a lot of them promise the world and may not deliver that. So you absolutely should shop around, okay? And that's why the 15-day rate shop period is crucial. For newer versions of FICO, it might be 45, but I recommend thinking of it as 15 because a lot of them are using the older versions, right? Now here's the thing, that only applies to auto loans and mortgages. So let's say March 1st to March 14th I applied for 12 mortgages. And in there, I also applied for 2 credit cards, okay? So 12 mortgages in that 14-day period, and then for some reason I did 2 credit cards. Little math question, how many inquiries do I have now?
3.
Yes, 3. All those 12 mortgage inquiries are 1, but the 2 credit cards are not going to count. They're going to count separately. They're not going to count within the 14 days like the mortgages because they're not mortgage applications. Same thing with auto loans, okay? If I went and did a bunch of auto loan applications and then I apply for credit cards or personal loans, it's going to be separate. And this is important because folks hear this rule, they go on YouTube or wherever and they hear this rule, they think, oh, for 15 days I can do whatever I want. Let me just apply for every credit card under the sun, okay? Believe it or not, we had a client who this happened to. And then they came to us and said, I have 38, I think it was, 38, maybe Tony will remember, 39 inquiries in like a matter of a week. I think they were getting alerts from the bureaus like, well, someone stole your identity because you just keep applying, right? Because they thought that everything would just count as one. But all those mortgage inquiries count as one, but then they had a bunch of credit card applications that didn't. Okay, it was kind of a crazy thing to do, but it's just important to keep in mind all mortgage inquiries is one, auto or one, everything else doesn't. Okay, now set aside all the mortgage stuff. Let's say I go apply for a credit card. They pull my credit, pulls my score down. How long does that hurt your score? It varies. It varies. It stays for 2 years. It could hurt you for a year. Yeah, it could hurt for a year, but let me say this. It depends on where your credit is right now. And this is kind of the thing that's kind of really unfair if you ask me. The better your credit score is, the less they count the inquiry against you. Yeah. Because they say, oh yeah, Daniel's responsible, so he can apply for credit, we don't care. But then, you know, if Tony goes and applies and he has a lower score, they're like, oh yeah, you know what, we don't think he's responsible. We're going to pull his score down more for the same inquiry. So the higher your credit score and the more credit that you already have, the less an inquiry dings you, okay? It's one of those facts that the lower your score, the more an inquiry is going to hurt you because they assume that your inquiry is being done irresponsibly or that you're not responsible with money, blah, blah, blah. That's what they think. So I would say people who have a 700 plus credit score, they can apply for credit, new cards, whatever you're talking, no problem 3 times a year. 2 to 4, let's say, so average of 3 times a year without dropping their score more than maybe 10 points, 15 points. But someone who has a 600 credit score and does the same thing, they could see their score drop 50, 60 points. So the point I'm trying to make is this. I'm not saying not to apply for credit, because if you have bad credit, how else are you going to build credit but applying? The thing is, if you have poor credit, you need to be very careful and very strategic about when you apply. You need to apply for the cards that you know you're going to qualify for, the ones with lower standards, things like that, because doing too many of these is going to pull the score down. So you do need to apply for credit. You have to build credit, but you want to be careful, okay? Credit cards are really where I see a lot of this, guys. Credit cards and personal loans, people keep applying, they keep getting their score lowered, because the reason why it happens is this. Their view with credit cards specifically, if you apply for a lot of them, they think that you're in financial distress. You know what? They lost their job. They want to get a bunch of cards and live off the cards. That's what they think. That's why they penalize you for it, okay? Now, for whatever reason, they don't think that someone with a high credit score would do that. You have a low credit score, and then you keep applying for cards, they assume you're in financial trouble, and they penalize you. So the point is, I recommend with credit cards and all non-mortgage, non-auto, try to avoid more than 3 times a year. Okay, if you're someone who's chasing credit and points and doing all that, it's probably okay because you probably already have really high credit. But if you have anything below a 700, try to avoid applying more than 3 times a year, really. Because it kind of sets you, it really sets you back. And it's one of those things that's unfair, but it's what happens. Now, some inquiries don't count, guys. If you are applying for a job, they do a background check, they do all those things, they pull your credit report, those don't count against your score. Okay, they do not count that. They're not, by law, they're not allowed to include those in those. It's only when you apply for loans they count it. Okay? When you get those, who gets those offers in the mail? Anyone? Credit card offers, loan? Okay. Those don't count against you either. Because those are technically an inquiry, but it's not an application. You didn't ask them to send it to you. They chose to go and mail it to your house. People are like, oh, does those hurt me? They don't. Those don't affect you, okay? If you want to get rid of them, you can cancel it so they stop mailing you, but it's not going to hurt your score or affect your score at all. So this is a meaty section, guys. There's a lot of stuff in here. So please, any questions you have, come at me.
If you ever decide to become a high school teacher, I totally support this, because this is stuff I needed way back. This is very thorough.
Well, thank you. I'm glad to hear. If they would teach us in high school, we'd have less of us with running issues. Yeah, I'm with you. I'm with you. Yeah, all the other classes you take, but this is not there, and it's crazy. Yeah. And then, and if you didn't get to school beyond a certain point, then yeah, you never learn it. But yeah, inquiries, guys, I know it sounds really complicated, but just keep these rules in mind. If you're shopping for a car or a house, try to do all the applications around the same time. And there's another reason you should do it around the same time, okay? As we know, mortgage interest rates change day to day, okay, based on the Federal Reserve and all that complicated stuff. If you apply with all of them on the same day, you can compare them head to head. Versus if you applied for one today and then one in 3 days, the rate could have gone up or down a little. You might not know exactly who was giving you the best deal. You apply for them all at once, it's kind of more beneficial to you because you can compare who's giving you the good deal. So that's basically that. Now, okay, inquiries leads us into identity theft. Why? The first sign that someone has stole your identity is they apply for credit in your name. One of the first signs, besides your bank account or credit card having charges, okay? If there's an inquiry you don't recognize, it's possible it was just a mistake. I'm not saying it's always identity theft, but being that we work with so many folks at identity theft, those inquiries are always the first red flag, okay? When that application for Chase pops up and you never applied for a card with Chase, when you know that, then you should be aware that something might have happened, okay? So inquiries are really important in that sense, but that brings us to...
Let me ask you on that.
Yes, please.
If you have an inquiry and something like that happens, obviously you're going to fight that.
Of course.
But is that automatically going to ding you as an inquiry that was, taken?
Until it's removed, it will, yes. Until it's removed. So if it happens, you didn't agree to it, right, Marco? So obviously they can't keep it on there. But until they remove it, yeah, it does ding you. Yeah. So it dings you, and you're dealing with someone who knows who has your identity and is running around. So the good news is that if it's unauthorized, you can get pretty aggressive really quickly, and we do that, and you can get it removed fairly fast. But yeah, until it gets removed, you are dealing with it. Yes, sir. Yeah. But here's the thing. The best way to prevent it is keep a really close eye on your credit reports. And here's one thing that I really want folks to take away, right? Monitor your credit every month, okay? I'm going to give you 2, and it's in our book, but we're going to tell you right now, 2 websites you should use, okay? Credit Karma, creditkarma.com is one. Free Equifax and TransUnion reports. They give you that Vantage score that I told you doesn't really matter, but they're giving you a free report updated every month. And the moment that there's a credit inquiry in your name, it's going to send an email. It's going to say, hey, Daniel, hey, Marco, someone just applied for credit in your name. And if you didn't apply for anything, you're like, wait a second, someone's doing something, okay? You can jump on it quickly and you can protect yourself from having this escalate into something where they go and do more identity theft on you. So Credit Karma is really good, and Experian.com gives you Experian for free. Keep an eye on those. They'll email you if there's an inquiry in your name, okay, or something else pops up, and you can really avoid it. Because the number one thing with identity theft is being proactive. The sooner it's caught, just like with a lot of illnesses, okay, the sooner it's caught, the better off you are. The more it drags on, legally, yes, you have the right to fight it, but it involves more time, more money, more headaches, yeah. So keeping an eye on your credit using Credit Karma and Experian is a really good way to avoid that, okay? And you might be wondering, I know this sounds weird, always use a credit card for purchases. Let me clarify. If you have a credit card and you go buy something, you're legally protected, okay? If, let's say you returned it or they made the wrong charge, or if your credit card account was compromised like we're talking about here, you can call the company and say, hey, I didn't authorize this, you have to charge it back, credit the account, and there's a lot of restrictions around what the credit card folks can do, okay, legally. Fair Credit Billing Act, FCBA, restricts them heavily. So if you basically, long story short, if you use credit card accounts, okay, if you use credit card accounts typically or use them more often, you sort of have more, how would I say this, more room to contest it if something happens, okay, because you can do that. Your debit card, if you're using your debit card a lot and your debit card gets compromised, like they steal it through a register, they do something like that, okay, your options are much more limited in terms of getting the money back because debit cards like cash, okay? It'd be like handing them cash. So credit cards, if you're going to use a card at the store, use a credit card rather than a debit card for the simple reason that if that card somehow gets compromised and something happens, your chances of recovering the money and reversing the charges are much better than if you use a debit card, which ended up draining the money and then they did that. So if you're going to go shopping somewhere, my recommendations are either cash or credit card. Really don't like using debit cards at stores. We've seen too many cases of identity theft where person's debit card got compromised by use at some store, they'd hacked into the card reader, their account gets drained, things happen. That happens on a credit card, they're going to reverse the charges when you come in and show it was identity theft, okay? So if you're going to go to, first of all, if you're going to a store where you have any doubts, just give them cash. If you have any questions, don't give them your card. But if you're going to use a card, use a credit rather than debit for that reason. Protect yourself. And it should be obvious, it really should be, but it's not. Okay, don't go on Instagram and put all, you can share stuff about yourself and your family as you like, but be careful how much other information is on there, okay? I know it seems obvious, but we're dealing with a lot of folks in maybe your generation and younger, and I'm dating myself here probably, but a lot of people are sharing a lot of information that puts you at risk, okay? Here, I've got some basic tips. Basically, review your credit reports. Go to Credit Karma, go to Experian. Keep an eye on your credit reports. Log in at least once a month, folks, to your bank accounts. Okay, go online, log into those bank accounts, those credit cards. Keep an eye that there's no weird spending on there, okay? Just kind of keep an eye on it because things can get hacked online. Things can get hacked when you went to the store. Who knows? If you live in an apartment complex, things could get taken because people stole trash. As crazy as it sounds, people have stolen trash and compromised accounts that way. Just kind of be vigilant about keeping an eye on your accounts every month, keeping an eye on your credit, and any financial documents, try not to just throw them in the trash, try to shed them, keep an eye on that. You do that, you're really going to avoid identity theft issues. It's just really a matter of just keeping an eye on things. Any questions? No? Okay. Student loans. Student loans are arguably one of the biggest financial challenges facing folks in this country right now, okay? And the chart you're going to see in a minute is going to drive home this point. But we've got about, depending on which figure you look at, Federal Reserve said around 1.65 trillion worth of student loan debt outstanding in our country right now, okay? Now you look at what that's doing to the rest of the economy, folks, because everybody who has that debt, now they try to go buy a house, debt to income is too high, can't buy the house, it hurts a lot of young families that are getting started. A lot of issues, okay? Now, it's obviously frustrating for anyone who's dealing with it, and I dealt with it myself, so really feel it. Here's to give you a quick idea, not directly relating to credit, but the amounts of money that's owned by age group. This is the one that really gets me, because Think of like, everyone who, as you get older and you're still dealing with this one as well, okay? This one is really one of the, we say the housing market is good, but it's not as good as it could be because of this number, because all these folks are stuck with these crazy payments, okay? And yes, some of them might be having, I don't know, some of them became a doctor or they went and got some Harvard degree and some job, okay? But a lot of times you're going to school to better yourself and get an education that's pulling you down, okay? So student loan debt is obviously an issue, but wherever there's a problem, there's a solution. There's no way to wipe out your student loan debt, okay? I should clarify that. There's nothing that says, it's very hard to get rid of in bankruptcy and other things, but there are ways to deal with it, okay? There are a number of plans that are based on income. So they'll look at what your income is for the previous year, and they'll reduce your payment amount based on your income to make it more manageable, okay? It still might be a fair amount of money you're paying, but it's not going to be something where you were earning $50,000 a year and you're going to owe $200,000 in student loan debt. They'll reduce the amount you owe based on your income, okay? And for a lot of folks who are because if they're looking at monthly payments when they're trying to qualify you for a mortgage, taking this option can help a lot. A lot of the mortgage lenders we work with, we kind of let them know, listen, let's try to get your customer into one of these plans if their income falls in a certain range, because then their monthly payment goes down, the total amount they're going to pay goes down, and it benefits them. Where it causes issues, at the end, the amount that was reduced, you may owe taxes on. So let's say that you borrowed $100,000, right? $100,000, and they agree to reduce it to $40,000 based on your income. You paid a $40,000 over, let's say, 8 years, $5,000 a year. At the end of the 8 years, that difference, the amount that was forgiven, it's a forgiven debt. You could owe taxes on it. Not always, but in many cases, you'll owe taxes on it. Okay. So what was the numbers I gave again? I said 40,000, right? 60 and 40. Yeah. Okay, yeah. So let's say if they had reduced it from 60 to 40, the difference is 20,000, right? You could owe taxes on that difference, the 20,000, yeah. Luckily not on the 60, but on the 20 you could owe taxes. But here's the thing, you run those numbers, you'll find it's still cheaper than having gone and paid out the 60. Yeah, yeah, and because then the IRS comes back, right? And then you're like, okay, they'll give you a payment plan, do whatever. But the point is that is an issue, but on average, folks, for a lot of people, these are a better option if the amount they're going to pay is reduced. It lets them get ahead financially, okay? And it is an option. Now, does anyone know how many months of student loan payments you could miss without having the loan written off or closed? Any guesses? 2 months? 4? It's 6. 6 months. If I miss 6 months or more of payments, the loan is treated as in default, okay? So not only am I past due, but the account is basically being treated into full delinquency status. But here's the crazy thing, and this is a really, really beneficial thing. You can have your account go bad. Let's say you couldn't pay student loans for quite a while. Okay, 2 months, 4 months, 6 months, 9 months. You can have that happen, the account is closed, Department of Education has it, it's destroying your credit. But if you come back and you call up the company, you call the Department of Education, you call Navient and you say, hey guys, I want to bring the loan current. They have a program. You can make 9 payments on time in 9 months. And I'm not talking the full payment amount. They'll do a reduced payment amount based on your income. They'll figure out what you earn, what state you live in, how big your family is, and they'll let you pay a reduced amount. Could be as little as $10, $20. You do that for 9 months, okay? 9 months, okay? Think of it like a baby. 9 months, okay? At the end of the 9 months, they're going to remove those late payments, and your score is going to go up. And this is by federal law, okay? The Higher Education Act provides for this. So anyone who had their credit go bad because of a student loan, you've got something you can do. Reduced amount for 9 months, and the loan is brought current. At the end of the 9 months, you had to decide, do I want to go into one of these programs, or what do I want to do? But that is one of the best ways to improve the score. See, so many folks who just gave up on their student loans, and a few years later, they want to buy a house, want to buy a car, okay? We tell them, listen, you're going to have to wait 9 months and do 9 months of payments, but when you do, score is going to go up, okay? And it really, really benefits you. It's one of the best ways to improve your credit score if you've got student loans that have not been paid. And I didn't recommend this for everyone, number 2, okay, loan consolidation. Each semester of school is a separate loan. So 4 years of college, 8 loans, right? That's eight loans that they're doing. Each semester they give you a different one. Now what happens if you pay late? Now you have 8 late payments. Don't want that, right? If you're going to pay late and a mistake happens, you only want one. Best way to avoid that is consolidate. Turn all the 8 loans into one. They combine all of it into one account, okay? They close all the old accounts. They take the 8 old accounts and make one new account. And they combine the amounts that were owed in there, okay? And they give you the lower interest rate of those accounts. So you're saving money on the interest, and you're protecting your credit, Should something happen, you're not going to destroy your score.
You
Okay?
have to have a good, decent credit to be able to qualify for that though, right?
You don't, actually. You don't. Because federal student loans don't have credit score requirements. Anyone can qualify. The one thing is, you can't be behind on your payments. So if you're up here, if you want to consolidate, but you're currently 6 months behind, you got to do number 1 first, and then you can do number 2. Yeah, yeah, yeah. It's a really good way to do it. So there's always light at the end of the tunnel with this, okay? This is a simple one. Mint.com is a free app. It's owned by a company called Intuit, which also owns Credit Karma. Mint lets you can link all your financial accounts, credit card, bank, mortgage. They'll give you advice on investing. They'll tell you where you're spending, okay? You can keep an eye and say, you know what, spending too much money on, I don't know, entertainment, or my credit card interest is just killing me and it's eating up my budget. It'll give you all these insights because, I mean, a lot of folks might know these things already, and that's great if you do. But for a lot of us, you know, I'll speak for myself, seeing it visually really helped me a lot, and for a lot of our customers as well. So Mint.com is completely free. Highly recommend it, because a big part of good credit is good financial management. And good financial management means proper budgeting, and Mint helps you with that. You can download the app, keep it on the phone. You can use it on your computer, totally free. They make money by trying to show you offers for credit cards and investments, but you don't have to take one. You can choose to take one or not. You may as well make use of the free resource they're giving to help you kind of keep your finances in order, keep your debts in order. And then you combine that with monitoring your credit on Credit Karma and Experian, and boom, budgeting is good, and your credit management's good. Voila. Now, as we've covered, okay, we address all types of negative items, folks, okay? Late payments, inquiries, collections, judgments, you name it. If they don't meet those legal requirements I mentioned, accurate, verifiable, timely, complete, then there may be potential to remove them. Credit inquiries as well we address. So one part of what we do is negative items. But here's the thing. Remember, all of this, except for inquiries, these ones are just this, okay? We also like to give our customers advice on all of these. So, you know, maybe get that authorized user card from your brother or your sister, open that. Maybe open that self-lender account. The advice is different for each person. Everyone has a different profile, okay? So part of it is cleaning up old bad credit. Part of it is opening new good credit. And sometimes part of it's just doing nothing. Just, you know, clean up a few bad things and just keep doing what you've been doing otherwise and just stay consistent, and you're going to be fine. The point is that everyone has a different situation and they need personalized advice, okay? Every single person in here has different needs, different priorities, different obligations when it comes to their finances. And that has to be taken into account. And what we focus on is really kind of putting together that custom plan. So not only are you addressing the negative items, you're also doing all of the other things in here to improve your score, okay? And that's some of our results, and we can talk more about that after.